The recent announcement of new tariffs by President Donald Trump has triggered a global response, with over 50 countries reaching out to the White House for negotiations. These tariffs, which are set to be enforced starting Wednesday, have caused significant volatility in financial markets and raised concerns about a potential recession. Key figures within the administration, including Treasury Secretary Scott Bessent and top economic advisor Kevin Hassett, have defended the tariffs, emphasizing the need to address what they perceive as unfair trade practices. Despite the backlash, the administration remains firm in its stance, suggesting that the tariffs are part of a long-term strategy to bolster economic fundamentals. The tariffs are impacting both U.S. allies and adversaries, with countries like Israel and Vietnam actively engaging in discussions to mitigate the effects. This move has sparked mixed reactions within the U.S. political landscape, with some Republican lawmakers proposing legislation to require congressional approval for future tariffs. Meanwhile, Commerce Secretary Howard Lutnick has confirmed that there will be no delay in implementing the tariffs, highlighting the administration's commitment to resetting global trade dynamics. The situation remains fluid, with ongoing debates about the potential economic implications and the future of U.S. trade policy.
The Securities and Exchange Commission, SEC, has clarified its stance on stablecoins, announcing that covered stablecoins are not considered securities and therefore do not require registration with the Commission. This decision, detailed by the SEC's Division of Corporate Finance, identifies covered stablecoins as those designed for payments, money transmission, or value storage, maintaining a stable value relative to the USD and backed by low-risk, liquid assets. However, the SEC emphasized that this view is not definitive for all stablecoins, as a thorough analysis of each coin's specific facts and circumstances is necessary for a conclusive determination. This announcement comes amid ongoing legislative efforts to regulate stablecoins, with both the House and Senate advancing bills to address these digital currencies. The House Financial Services Committee has moved the Stablecoin Transparency and Accountability for a Better Ledger Economy (STABLE) Act forward, which aims to provide guardrails for innovation. However, some Democrats argue that the bill lacks sufficient consumer protections and regulatory oversight. Concurrently, the Senate's Genius Act is progressing rapidly, backed by bipartisan support and prioritized by President Donald Trump. These legislative developments indicate a growing focus on establishing a regulatory framework for stablecoins, which could significantly impact market operations and consumer protection in the digital currency sector.
The recent announcement of sweeping tariffs by President Donald Trump has sent ripples through global financial markets, with significant declines observed across major indices. The tariffs, which include a 10% baseline levy on all imports and higher tariffs on approximately 60 countries, have been justified by Trump as a necessary medicine to rejuvenate the U.S. economy. However, the immediate market response has been stark, with Asia's Nikkei 225 plummeting by 7.8% and Hong Kong's Hang Seng dropping over 12%. In the U.S., the major stock indexes experienced their most significant weekly losses since 2020, with the S&P 500 falling nearly 6%. Financial institutions like J.P. Morgan have raised concerns, predicting a 60% chance of a U.S. and global recession as a result of these tariffs. Key U.S. officials, including Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick, have downplayed the recession fears, suggesting that the tariffs are part of a strategic adjustment process aimed at leveraging better trade deals. Despite this, the international response has been mixed, with countries like China announcing retaliatory tariffs of 34% on U.S. imports, while others like Indonesia and Taiwan have opted against immediate retaliation. The geopolitical implications are significant, as leaders from the UK and Canada have expressed concerns over the potential for an all-out trade war. The situation remains fluid, with ongoing diplomatic engagements, such as the upcoming meeting between Trump and Israeli Prime Minister Benjamin Netanyahu, likely to further influence the trajectory of global trade relations.
The Asia-Pacific markets experienced a significant sell-off, driven by escalating fears of a global trade war following U.S. President Donald Trump's imposition of tariffs. The Nikkei 225 and Topix indices in Japan plummeted over 7%, triggering a suspension in futures trading due to circuit breakers. This steep decline marks an 18-month low for the Nikkei 225. Hong Kong's Hang Seng Index and Hang Seng Tech Index led regional losses, dropping 13.22% and 17.16% respectively. Mainland China's CSI 300 also saw a sharp decline of 7.05%. The market turmoil is largely attributed to Beijing's retaliatory tariffs, which have intensified trade tensions and contributed to a risk-off sentiment among investors. The impact of the tariffs extends beyond Asia, with U.S. stock futures falling sharply in anticipation of further market disruptions. The Dow Jones Industrial Average and S&P 500 experienced significant declines last Friday as fears of a global recession loomed. The trade conflict is expected to raise U.S. effective tariff rates significantly, potentially increasing domestic prices and dampening economic growth. Analysts from Schroders estimate that the tariffs could reduce GDP in China and Vietnam by over 0.5%, while the European Union and Japan could see a GDP hit of around 0.3% to 0.4%. Amidst the volatility, some analysts view the pullback in sectors like financials as a potential buying opportunity, with valuations becoming more attractive despite the ongoing market uncertainty.
The primary financial event discussed is the clearance of regulatory hurdles for Czech investor Daniel Kretinsky's £3.6 billion takeover of the UK's Royal Mail, under the umbrella of International Distribution Services, IDS. This acquisition has sparked significant debate due to the strategic importance of Royal Mail as a public utility, akin to industries like water and steel. The transaction's completion, expected by April 30th, raises concerns about foreign ownership of critical infrastructure and its potential impact on service obligations and pricing, particularly as Ofcom conducts a public consultation on the Universal Service Obligation, USO. The transaction's financial structure involves a £3 billion debt financing from foreign banks, echoing concerns seen in highly leveraged deals like Asda's, which suffered market share losses due to management and interest rate challenges. The deal's implications are broad, affecting stakeholders from minority investors to the Greeting Cards Association, who feared diminished influence in future corporate decisions. The transaction is viewed against the backdrop of increased recession risks due to global market disruptions such as the Trump tariff war, highlighting the broader economic and strategic implications of foreign takeovers of national assets.
Ukraine is preparing to send a delegation to Washington next week to negotiate a comprehensive mineral resource deal with the United States. Led by Economy Minister Yulia Spiridenko and involving key Ukrainian ministries, the discussions aim to grant the U.S. access to Ukraine's extensive mineral reserves, including titanium, lithium, and uranium, which are vital for industries such as aerospace, battery technology, and nuclear energy. The negotiations, which follow a previously derailed framework agreement, now also include discussions on gas and oil sectors. The deal is significant for enhancing U.S.-Ukraine relations, particularly amid ongoing geopolitical tensions with Russia. For Ukraine, securing U.S. support is crucial in its conflict with Russia, and the agreement could be a strategic move to solidify that backing. However, leaked drafts of the agreement have sparked criticism within Ukraine, raising concerns about national sovereignty and control over its natural resources. Ukrainian lawmakers are particularly wary of the implications for Ukraine's sovereignty in managing its mineral wealth. As negotiations progress, Ukraine aims to establish clear principles to protect its interests while exploring opportunities for joint investment and economic collaboration with the U.S. The outcome of these talks, which will require ratification by Ukraine's parliament, could have substantial implications for Ukraine's economy and its geopolitical relations, influencing both market dynamics and strategic alliances.
The Rosen law firm has initiated a securities class action lawsuit against the Bancorp Inc., Nasdaq TBBK, alleging that the company made false and misleading statements about its real estate bridge loan (REBL) portfolio. The lawsuit, which encompasses the period from January 25, 2024 to March 4, 2025, claims that Bancorp understated the risk of default in its real portfolio, used inadequate credit loss methodologies, and had material weaknesses in its financial reporting controls. These issues allegedly led to misleadingly positive statements about the company's financial health, resulting in investor losses when the true situation was disclosed. Investors who bought Bancorp securities during the specified timeframe are encouraged to join the class action before the lead plaintiff deadline on May 16, 2025. The Rosen Law Firm, known for its expertise in securities class actions and history of securing significant settlements, stresses the importance of experienced legal representation in navigating the complexities of such litigation. The outcome of this lawsuit could affect Bancorp's financial standing, regulatory scrutiny, and stock market perception. Investors are advised to carefully consider their involvement to potentially recover losses incurred from the alleged misinformation.
Precious metals have reached new heights, with COMEX gold surpassing the $3,100 mark for the first time. Driven by concerns over U.S. tariffs and potential interest rate easing by the Federal Reserve. In March, gold achieved a 10.1% increase, closing at $3,157.40, while silver rose by 9.65% to $34.76 per ounce. Despite global gains, the strengthening Indian rupee tempered domestic market performance, with NCX gold and silver rising 6.8% and 5.8% respectively. However, recent trading sessions have seen a pullback in prices, attributed to overextension and recession fears, with short-term outlooks turning negative. The long-term trend for precious metals remains positive, although COMEX gold could see short-term declines to $2,980 to $3,000, and silver may test support between $26 to $26.50. Similarly, domestic NCX gold prices, after hitting record highs, may fall to the 84,500 rupee to 85,000 rupee range, while NCX silver could dip to 80,200 rupee to 80,700 rupee. The recent price corrections reflect a broader market adjustment, yet the fundamental drivers suggest potential for a resumed upward trajectory post-correction.
The UK government, led by Prime Minister Sir Keir Starmer, is preparing to counteract the economic impact of newly imposed tariffs by the United States under President Donald Trump. A 10% baseline tariff on all imports and a 25% tariff on car imports into the US have been implemented, significantly affecting the UK's automotive sector, which exported approximately £9 billion worth of cars and auto parts to the US in 2024. In response, Sir Keir plans to ease the annual electric vehicle sales targets while maintaining the 2030 ban on petrol and diesel cars, providing flexibility for smaller luxury car manufacturers like Aston Martin and Rolls-Royce. Additionally, the UK government is considering reimposing anti-dumping safeguards to prevent an influx of diverted goods from markets affected by US tariffs, which could undercut domestic suppliers. The Department for Business and Trade is in discussions with the Trade Remedies Authority to monitor and respond to these challenges. To further support UK industry, the government is expected to expedite announcements on investment in domestic industry and infrastructure. Moreover, the UK aims to strengthen trade ties with other nations affected by US tariffs, such as India, to secure better mutual market access, highlighting the urgency of adapting to what the government terms an economic shock.
Transmedics Group Inc., NASDAQ, TMDX, is currently embroiled in a securities class action lawsuit initiated by Rosen Law Firm, a respected global investor rights firm. The lawsuit is aimed at investors who acquired Transmedics securities between February 28, 2023 and January 10, 2025. It alleges that the company engaged in deceptive practices, including kickbacks, fraudulent overbilling, and unsafe operational procedures, which misled investors and resulted in financial losses. The deadline for investors to join the class action as lead plaintiffs is April 15, 2025. The allegations, if proven, could lead to increased regulatory scrutiny, financial penalties, and a potential decline in the company's stock price, thereby affecting investor confidence and Transmedic's future operations. Rosen Law Firm, known for its success in securing substantial settlements in similar cases, underscores the importance of experienced legal representation in such matters. The outcome of this lawsuit is of significant interest to stakeholders, as it may influence the company's financial health and reputation. Investors with losses exceeding $100,000 are particularly encouraged to evaluate their legal options.